we are going to focus our attention on the most important non-banks in the United States in terms of assets under management. First off, insurance companies. The economic function of insurance is risk mitigation. From my perspective, it is a form of saving for a rainy day. I transfer the risk of some adverse event to an insurance company, I pay a premium, and then in the bad state of the world, I make a claim and the insurance company pays out. From the insurer's standpoint, payouts become predictable as they write more and more and more policies. There are many insurance markets, but the two most common are life and property and casualty. With life insurance, I'm protecting against the potential loss of earnings from disability or death. My favorite example of life insurance is Scottish Widows. This was a policy set up in the 19th century in Edinburgh, Scotland, to provide income to the families of men serving in the Napoleonic Wars should they die in service. Property and casualty insurance protects households and businesses from losses due to natural events. You can think of floods and fires. Or due to accidents. A good example is a car accident. What may be surprising is that these insurance premia are pooled and invested. My saving for a rainy day is channeled to borrowers. More precisely, the source of funds for an insurance company consists of pooled premia. Insurance companies use these funds to make payouts on insurance claims. However, they also make long-term investments in stocks and real estate and bonds. You might not have known that insurance companies are among the biggest investors in US corporate bonds. Next, we have pension funds. Pension funds are used to store and grow our wealth into the future. Households can save for retirement beginning at a young age and often in a way that is pre-committed. In my case, some 8% of my paycheck is set aside whether I like it or not. Retirement savings accounts usually offer some tax benefit, such as a deferral of income tax. Sometimes employers make contributions to these accounts. Once I reach retirement, I receive a payout from the fund, usually in the form of a lump sum or a life annuity. Pension funds source their funds by pooling employee and employer contributions, and then the pension fund uses these funds two ways. It makes long-term investments, primarily in bonds, stocks, and real estate. At the same time, it manages these investments to make payouts to retirees. Pension funds and life insurance companies are in a very similar line of business. Pension funds make payouts if you make it to retirement, whereas life insurers pay out if you do not. Sorry if that sounds a bit morbid. Given these similarities, these businesses tend to make the same investments. We also see the larger life insurance companies managing pension funds and vice versa. There are two main types of securities firms. First, we have investment banks. While commercial banks decide which households get mortgages and at what interest rates, investment banks decide which firms can issue securities in capital markets and on what terms. Underwriting is the bread and butter of investment banking. Let's say a corporation wants to issue some securities. The investment bank will commit to purchasing the entire issue at some price. It will then place the issue with outside investors shortly after, hopefully at a higher price and yielding some profit. Taking a step back, investment banks have two economic functions. First, they are in the business of collecting and processing information about potential borrowers. They act as gatekeepers for capital markets. Second, they connect savers and borrowers through the underwriting process. Investment funds are very different. They pool savings and make investments in large, diversified portfolios of assets. This allows investors to store and grow their wealth into the future. There is a wide variety of mutual funds and exchange-traded funds that serve this purpose. Retail investors can access these funds with minimum investment requirements and low transaction fees. they have a variety of investment profiles. Money market funds only invest in super safe and short-term bonds. Equity mutual funds are riskier. The pooling part is very important. Vanguard, which is one of the largest mutual fund families, will offer a mutual fund that tracks the S&P 500 with a minimum investment of $3,000. It would be very challenging to replicate this investment without their help. Hedge funds are an infamous class of investment fund. They cater to wealthy and sophisticated investors only. A hedge fund can either have 99 investors, each with a net worth in excess of $1 million, or 499 investors worth more than $5 million apiece. Avoiding uninformed retail investors, that's you or me, allows hedge funds to sidestep certain regulations. This means hedge funds can pursue high-risk, high-reward investment strategies across securities and derivatives markets and face very little scrutiny. Next, we have finance companies. These financial institutions look a lot like banks, only they cater to a specific loan market. Some focus on consumer credit, which is credit for household purchases. This could be a mortgage to buy a house, an installment loan for an appliance like a fridge or a washing machine, or an auto loan to buy a car. For example, the Ford Motor Credit Company finances car sales. Other finance companies specialize in business lending. This could be anything from financing an aircraft purchase to providing a lease for farm equipment. Finance companies act a lot like banks, but with a specific industry focus. Granting loans and leases is their primary activity, just like banks, and they minimize information costs by screening and monitoring borrowers. However, they're not banks, and their fundraising activities reflect this. Finance companies are not funded with deposits. They are instead funded with bonds and bank loans. Our final major class of non-bank is the government-sponsored enterprise, or GSE. These are key players in the United States mortgage market. Who am I talking about? Well, there are three financial institutions here. The Federal National Mortgage Association, also known as Fannie Mae. Fannie was established in the 1930s. The Federal Home Loan Mortgage Corporation. This guy is Freddie Mac, and it arrived on the scene in 1968. Finally, we have Ginnie Mae, or the Government National Mortgage Corporation, which also arrived in 1968. All of these financial institutions were established by the US government. Ginnie is wholly owned by the government. Fannie and Freddie are private corporations, although since they were established by the government to serve the public good, they have been dubbed GSEs, that is, government-sponsored enterprises. The GSEs support home ownership in the United States, especially among lower-income and underserved communities. This includes loans for low-cost housing or loans to Army veterans. The GSEs achieve this by subsidizing mortgage interest rates. This happens either through direct lending at below market rates or by guaranteeing repayment on certain real estate financial instruments issued by other financial institutions. These guarantees act a lot like insurance, which makes these subsidized loans less risky. Putting this together, the GSEs raise funds by issuing bonds or selling loan guarantees to other financial institutions, and they use these funds two ways. First, and primarily, they grant mortgages. Second, they make insurance payouts related to their loan guarantees. Okay, we have covered the major financial institutions in the United States. Our final task is to examine the relative importance of these institutions. To do this, we will look at data from the US flow of funds. These data are collected and processed by the Federal Reserve. They contain estimates of the asset holdings of banks and the major groups of non-banks. we are going to examine two different time periods, 1970, or as I like to call it, ancient history, and 2018, which is more or less today. What do we see? Well, two things stand out. First, the declining share of banks among these financial institutions. In 1970, banks funded more than half of all assets. By 2018, this had declined to less than 25%. Insurance companies also experienced a decline. Who stepped in? Clearly mutual funds. Their share of assets has increased from less than 5% to more than 30%. This reflects the increased access to low-cost index investing through products offered by Vanguard and other investment funds. Let's sum up. Financial institutions channel funds from savers to borrowers. There are many bank and non-bank financial institutions involved in this process. We have characterized these institutions in terms of their key economic functions and balance sheets. Data indicate that banks play an important role in financing around the world. In the US, however, non-banks, especially mutual funds, seem to have become prominent in recent years. At this point, we have not discussed any potential implications, good or bad, of this reallocation. That is for another time.